Is the market finally ready for a deeper pullback here? Today we saw an exhaustion gap and trap. There are still some bearish divergences in play out there, and the 5-year auction did not go well at the 1 o'clock time frame. Tomorrow we get the 7-year. All of this helps us better understand if we can continue in the downward direction. So let's build a game plan based on logic to navigate the end of this week. As always, check out the links listed down below in the description. Hit the thumbs up button and subscribe if you've not already done so. And stay tuned until the end of today's show. I've got 4 additional trade ideas to share with you that you won't want to miss. With that said, let's jump right into the charts. Let's kick things off with a closer look at the SPY daily time frame chart. Let's begin by putting things in a vacuum. Today's red bar, of course it looks bearish in a vacuum. Solid red body, a little bit more upper wick as compared to lower wick down here. Sellers did a great job closing extremely weak near the lows of today's session, but that again is just entirely in a vacuum. If we add even just the slightest bit of context, let's not even talk about daily trend yet, but let's talk about bar to bar location, right? Low, higher low, high, meaningful higher high, and we hardly even dipped a toe into the previous day's trading range. So, is there really any progress that was made in the downward direction? To me, the answer is absolutely not. But now let's continue to zoom out a little bit. If we bring in the full context of the daily chart, here's a low, here's a higher low, high, higher high, new all-time high, and the highest high in the trend sequence, of course, means that we can afford a pullback on the daily time frame chart to look for a higher low, and we will still remain within an overall uptrend. And also, if we think about the context and the sort of characteristics of the market recently, I want to bring your mind back to last week. I mean, Thursday, beautiful gap fill reversal. Friday, beautiful gap fill reversal. Monday, beautiful gap fill reversal. I mean, it wasn't as pretty as Thursday and Friday. However, beautiful hold of Friday's high as Monday's low. Tuesday, we respect the same exact level. And today, we break out via a gap of this 2-day balance over here. So if the market has proven to us that it likes this gap fill reversal in the upward direction phenomenon, the buyers are stepping up at previous day's highs, it makes sense that not falling into the previous day's range, or this 2-day balance range, if you will, would have to side as more of a bullish than bearish phenomenon. Now, it would have been even better if we just went gap and go, or if we went partial gap fill reversal and then traded to a new all-time high and closed at that new all-time high. However, we're dealing with the chart in front of us. And as of right now, as long as we were outside of this 2-day balance range, I would not overstay your welcome or even be thinking about moves in the downward direction. Basically, the MO at any new all-time high is, generally speaking, you will be in an uptrend because you're making new all-time highs. And how do we participate in uptrends? Simply put, you're looking to buy higher lows, or you're looking to buy equal high breakouts. That really sets up 2 things into the remainder of this week. There's your equal high breakout right over here. So number 1 is, if we can find on the hourly chart, and we'll get there in just a second, reversal patterns off the top of the 2-day balance here around 484.40, great, we'll trade it back in the upward direction. We'll make a move towards the equal high here. The opening print of today's session would be your primary target. Just to give you that number, that is closer to 487.85. All right, so holding here, back up to today's opening print, that is a pullback trade. This is now going to act as a higher low because, yes, we have fallen into an hourly downtrend via today's individual bar. Let's say that you're not comfortable taking this pullback trade and you want to look for further balance up here. I would say that is completely fine. You're justified in that line of thinking. If we auto-zoom this chart, let's look at how the market has acted ever since the October low, right? October low, very gappy, and then we make this sideways consolidation, gap up, sort of sideways consolidation, so on and so forth, sideways consolidation, this breakout, more sideways consolidation. What I'm getting at is it wouldn't be unreasonable to say, okay, we just experienced range expansion. Now we're looking for range contraction, aka consolidation up here near these highs. A certain amount of duration goes by, and then we look for continuation in the upward direction, breaking out of this as some sort of daily bull flag up here towards the all-time highs. That is what the bulls want to see ultimately, to continue this chart on the daily time frame in the upward direction. But what about the bears? Where do the bears finally build a little bit of an edge? Keep in mind, it's a very, very minor edge. If we are going to get thin structure retracement, all that needs to happen is you need to take out 482.85. If there is a move inside of the 2-day balance range, okay, then first indication that something is going differently is that we are not getting a gap fill reversal off of the 2-day balance range. We are no longer dealing with this type of phenomenon back here. So, okay, we're neutral in this area. If we were to sweep the lows, all of a sudden we have thin structure underneath us. But let me ask you this as a key question. You can answer this on your own, right? Do we want to be aggressive? Do we want to be like looking for huge new money shorts in the market for the market to go to zero? The answer should be absolutely not, because again, we're pulling back from the highest high in the trend sequence, which is a new all-time high, and we know that there's the possibility for a daily high or low at or above your previous all-time high, 480 roughly, and then our line in the sand is still way down here. Keep in mind, this has not moved. It's the top of the balance range. Resistance, resistance now has the opportunity to act as support, especially when pulling back from the highest high, right? So if we were to get something really nasty, I would not change my tone on the daily time frame chart unless there's a clear breakdown and violation underneath 477.50 that really goes back to what we discussed in the Saturday update video. As of right now, is this a logical place for the market to slow down? We already talked about how this was an exhaustion gap up, meaning that buyers did not really want to participate up here gapping into new all-time highs. I would say it's totally reasonable. For resistance, we have the upper edge of this week's expected move. We're moving into blue sky territory, so what else do we have to go on other than the expected move? That's certainly one thing I would keep in mind. Another thing I would keep in mind is that this, as a balance range, generally speaking, the measured move is a range double. And if we were looking for something like 487, we certainly hit that, and that target has been fulfilled. So is it reasonable that the market could pull back from here and search for the next bullish setup on the daily time frame chart? To me, the answer is absolutely. So I think the game plan on the daily is very straightforward. We want to try to trade in the direction of the trend. The trend is up. New all-time high was produced. The most bullish outcome would be some sort of gap fill reversal over the two-day highs, 484.40, trade back up to the equal high, if not a new all-time high. If we get in here, we're neutral. If we get underneath 482.85 on the hourly chart, we can start thinking about short scalps to get here, but I would put my thinking cap on and say, can we find buyers stepping up at the previous all-time high, or worst case scenario, can we find buyers stepping up at the top of the daily balance range? 477.50 is still very much so in play after today's new higher high in the sequence. As we get granular on the hourly time frame chart, things actually get even more interesting, because what you'll notice is if we take out a Fibonacci from today's open down to the previous high of day, so this would of course represent the gap, right? We're going from the previous day's high to today's opening print. Notice that the lower wick on the first hourly bar goes right to the 50% Fibonacci retracement. That's a half gap close. And then we actually make a new high into the afternoon. So what is this sort of suggesting about the market participants is that this pullback on the morning session was nothing more than overnight inventory correcting. They got a little bit too long in the overnight, especially at poor location up towards the overnight highs. We correct some of that inventory. This is not strong new money sellers entering the market. Buyers step up on the partial gap close, and what do? We make that new higher high. It's only once the catalyst of the bond auction going poorly at the 1 o'clock time frame hits that we see sellers entering the market. And this is much more driven by the actual mechanics of higher interest rates putting downward pressure on markets. It doesn't really have anything to do with stronger sellers either stepping up or not stepping up. It's just purely the nature of higher rates, lower equity prices, right? So because of that, we're not seeing any evidence that stronger sellers are getting active, and therefore the daily thesis really stands where if we can hold on to this gap fill reversal area here at 484.40, we're kind of in the clear, right? This is going to act as a beautiful higher low. Maybe it turns into a double bottom like this. We break the neckline. What's the target? It's back up towards today's opening print, as we discussed on the daily. Another possibility here is that we actually turn this into an inverted head and shoulders. So there's a little bit of a dead cat here, then some sort of sweep to the downside, and this is very intentional here, then a higher low over here. The intention is that we actually take out, just by a little bit, 482.85. Let's talk about this level for just a brief moment. It's technically a very mechanical level. This is the improper end of the auction when it comes to S&P price action. So I know we're talking about bond auctions, we're talking about S&P price auctions. This is a price auction for the S&P. All price action is just an auction. There's a buyer and there's a seller, right? So put bonds in the rear view mirror for now. This auction ends properly because there is no excess at this particular level. We go right to it. So technically speaking, if there needs to be repair, if we need to put in some excess, a sweep of that level at 482.85 and then any higher low over 482.85. Obviously, the ideal illustration would be over the neckline of this as a double bottom over the top of the two-day balance range at 484.40, but a higher low above cleans up the structure at the lows, and then we're looking for the same thing. The target would be back up towards today's opening print. And once again, let me give you that number. We just keep saying it, but it's 487.85 roughly, okay? So that would be your upper target. And this is one hypothetical situation if it requires sweeping the lows. If the sellers are really going to get active here, again, their main goal is to turn this into overhead supply. So what we would want to see is a move into this area, then some sort of breakdown like this with a lower high underneath. This is what confirms it, right? It's the lower high underneath, 482.85. Then we trade through this as thin structure with overhead supply weighing on us in the downward direction, and we look for the retest of your previous all-time high at 480. So am I willing to take that trade in the downward direction? Yes, but only after there is a very obvious hourly lower high underneath 482.85. At this point in time, with the new all-time highs being produced, with the clear momentum in the upward direction, I do not want to try to be a hero and short this market because I believe the market needs to, quote, pull back or it's gone too far too fast. None of that. If we get the lower high, if there's clear evidence that yes, this can turn into overhead supply, I will trade through the thin structure. But as we said on the daily, we're putting our thinking cap on when and if we get to the previous all-time high. It's very logical that you could get a daily higher low around this area or a daily higher low around this area here. We know that 477.50 is our line in the sand. And not for nothing, just to continue along with the pattern projections, right? This, of course, could act as some sort of head and shoulders. And in that case, this would be your neckline at 482.85. But let's put the focus back on 477.50 for just a brief moment, because if we also take a fib from the bottom of the move up to the most recent high that was produced today, the 38.2 is in no man's land, but look at where your 61.8 is now. It's the top of the balance range at 477.50. And what do we know about 61.8 fibs? These always act as lines in the sand. So to me, 477.50 is a big time line in the sand now that we're getting confluence with that particular perspective. The last thing we'll do here before we take a look at market internals is throwing on our intraday anchored VWAPs. And the illustration from this point of view is that this will or can provide confluence early on the Thursday session or even midday Thursday up towards that 484.50. If we break down underneath, this is why we want to remain neutral below, because you're underneath your Friday breakout anchored VWAP, right? So that is what we have here. The last thing to sort of talk about is just that reminder that the 7-year auction will happen tomorrow at the 1 o'clock time frame. I know not everybody makes it to the bond section of the videos. I just wanted to make it very clear, 1 o'clock tomorrow, expect some more volatility. Historically, over the last couple of auctions, they have been going poorly, and a poor auction generally yields higher interest rates, and higher interest rates means downward pressure for equities markets. So keep in mind, if at 1 o'clock you see the market moving in the downward direction, it may not be stronger sellers stepping up in the market. It could purely be just the mechanic of higher rates, lower equity prices. Keep in mind the inverse of this coin, right? Let's say at 1 o'clock, everything goes swimmingly, everything is fine. What would that tend to sort of, lead me to believe? Okay, if the auction goes well, which would be different from what the status quo has been, it would be different from what happened on today's session, then great. We're still looking for buyers to step up at this particular level here if we're holding it at 484.40. With that said, let's take a look at some supporting evidence. Market internals are always Exhibit A. If you're not familiar with this screen, check out the video tutorial in the top right-hand corner. Let's remember that Monday and Tuesday were consolidation, so this is bullish consolidation, bullish consolidation, bullish consolidation. Not the best bullish consolidation, but we're certainly spending a majority of distance over the zero line as compared to under the zero line on Tuesday, and then the same thing out of the cumulative builds on the tick down below. Certainly more flat and passive, closing the day positive even on Tuesday after dipping a toe negative earlier on in the session. So if we examine today's gap up, let's again think about this logically, remembering everything we just discussed on the hourly chart, that there were no stronger sellers getting involved ahead of the 1 p.m. bond auction, right? What's going on with volume flows? Certainly more bullish than bearish over the zero line, moving in the upward direction. Advanced decline line opens in trend higher zone. That's to be expected with such a gap up of this magnitude. But really, we start to consolidate here over 500. It's only at the 1 p.m. bond auction where things start to deteriorate a little bit further. And the same thing can basically be said about the cumulative build. So all things considered, we do not have stronger sellers entering this market. The only reason the market moved more aggressively lower today was because of purely market mechanics, higher rates, lower equity prices. Market profile is always Exhibit B. If you're not familiar with this screen, check out the video tutorial in the top right-hand corner. Let's begin with our value area and point of control as we typically do. Here's Monday, here's Tuesday, and here, of course, is today's Wednesday session. I really like the fact that the value area and point of control on Monday and Tuesday are lower in the individual sessions. And the reason behind that is because it'll become much more difficult to turn those folks into overhead supply. You'll truly need a breakdown through the bottom end of the 2-day balance instead of just a breakdown of an upper distribution value area. Let's say that value is up here. Let's say that value was up here on the Tuesday session. All of a sudden, as soon as price starts crossing down underneath here, now it's like, okay, we should expect these two lows, and because they're still mechanical, we'll talk about that in a second, we should even expect a breakdown of those two lows. Whereas in this case, the way that the profile is currently situated, it's going to be much more difficult to turn these people into overhead supply until you literally take out the bottom end of the 2-day balance range, right? So in terms of mechanical lows, that's when two things are very precise. So you're getting number 1 and number 2 over here. I wouldn't quite quite throw in the overnight low in that mix, but it's still in there. You're just getting a big balance area overall if you were to sort of make a composite profile out of these three, maybe even the fourth of the Sunday overnight session. And then additionally, on top of that, you also have this poor low on the Tuesday session. A weak low and a poor low are two different things. Weak low is more synonymous with a mechanical area, which is when things are precise like such and such. A poor low represents the improper end of the auction, price action auction, on the Tuesday lows, right? There was no excess that was put in over here. You could even say you have lack of material excess on the Monday session. We did repair the high, and we repaired the high over here via the move lower to tag up to those places on today's lows, but these areas still could use some repair structurally. So the idea is, on the hourly time frame chart, just like we described, if we sweep through this area, so we're just going to draw over here, we sweep through those lows, let's bring them in there, there we go, and then we get a higher low back above, the breakdown is not where you want to be bearish, because all that could be happening is the repair of this poor low, the mechanical low, and any higher low above now turns any of these suckers into shorts with terrible location at the bottom end of the move. The overall daily trend is up, and we trade back in the upward direction, right? What you need to see on the hourly time frame chart for all of the reasons we can see here on the market profile, value area lower, mechanical low, everything we've discussed so far, you need to see the lower high underneath the two equal lows on the daily chart before you start looking for stronger shorts in this market. The last thing I'll leave you with here is that we do have lack of material excess at the highs of today's session, and we have a small spike in M period from today's session at the lows. If we open over the spike, any shorts who are initiating at the lows of today's session should be cooked, and we'll look for rotation in the upward direction. That would just be a simple hold of the two-day highs we discussed on the daily time frame chart. If we open in M period, I think it's a wait and see, and if we open underneath, technically we should auction lower. That's what spike rules would state. We could look for the repair of this area here and then take it in stride from that point forward. Moving along, let's do the same thing for the QQQ NASDAQ 100, kicking things off on the daily time frame chart. Nasty red-bodied inverted hammer printed on today's session. So again, in a vacuum by itself, nasty price action. Sellers stepped up near the highs, closed weak down towards the lows of today's trading range, but on the bar-to-bar count, clearly a higher low outside of entirely the previous day's range. And that's very characteristic of the Qs recently not closing the gap even when the S&P does. So here's an example on Friday of last week. Here's an example on Thursday of last week. So anything out of the ordinary here? Not really. Of course, we're coming from the highest high in the trend sequence. We have lows, higher lows, we have highs, and of course, higher highs happening here. So a couple of things could yield a daily higher low. The most bullish and optimistic look would be respecting the top of the two-day balance here, gap fill reversal, then trading back in the upward direction. Anything deeper than that, just like the S&P, no need to repeat all the same psychology behind it. We want this to turn into overhead supply by breaking down with a lower high underneath 421.25, and then we will trade in the downward direction and look for your next higher low somewhere around this zone. Keep in mind that we do have thin structure in this bar from the Friday breakout. We'll see that on the hourly chart in just a second. When we get down here, just like the S&P, again, we are looking for a double bottom. We're looking for a hammer candle. We're looking for a very simple inverted head and shoulders, something that would indicate buyers are stepping up off the top of the daily balance range over here. But let's keep in mind that this is not as clean of a daily balance as what the S&P offered. So instead, we were referring to this as a pie in the sky inverted head and shoulders. And as always, the measured move is from the head to the neckline of the pattern. If you stack that from the neckline going forward, are we pulling back from a reasonable point? The answer is absolutely. Upper edge of this week's expected move was also confluence with the measured move from the inverted head and shoulders. So the daily chart is making sense. It's very logical that the inverted hammer could yield a little bit more of a pullback. We know that our line in the sand to really unlock more bearish trades into the Thursday or Friday session will happen underneath 421.25. No reason to complicate it any further than that. Let's bring it on down to the hourly time frame chart. What you'll notice is the same exact thing in the morning session where we got a partial gap close underneath. Again, the whole day was a partial gap close, so that would instantly tell us that it was more bullish than bearish in the QQQ anyways, but partial gap close off of the open, inventory correction, then rallied to make a new intraday high. Same commentary as the S&P. The 1 o'clock bond auction, which was a 5-year, again, went sour, and the higher rates certainly are going to put more pressure in the downward direction on the NASDAQ. So here's where things get a little bit different. If you've made it to this point, you've made it to the little nugget of gold, which I hope to impart to you on today's episode. The NASDAQ, the Qs are always going to be more sensitive to interest rates. So if the 7-year goes poorly tomorrow, you want to look for shorts on the NASDAQ side of the market, not necessarily the S&P. The S&P, of course, has a broader base, all of these different sectors, which comprise it as a whole. And so far, we're actually seeing healthy rotation. This most recent leg higher in the S&P was brought to you by a big move higher in the NASDAQ. And as we know, when we were getting this pause pause over here, the NASDAQ was taking a back seat to none other than the IWM. The IWM saw a nice move early on the week. Monday session was a big gap. We'll talk about that in just a moment. And it's very possible that the IWM could pull back looking for a higher low. Today was quite nasty, down about 2%, right? If the IWM gets a higher low while the NASDAQ is pulling back, it's going to be a recipe for a sideways or at least sustained S&P rally. I would not be looking for shorts in the S&P. If the 7-year goes bad, I would purely be looking for the NASDAQ side of the market to exhibit much more relative weakness. Now, again, don't let the 7-year auction sort of distract you from the main purpose of these charts. We're still waiting patiently for the breakdown of 421.25. Could the 7-year bond be a catalyst tomorrow at 1 p.m. in the afternoon? Absolutely. But when there's actually a lower high underneath, look left. That's really when the stronger trade setup happens to the downside. This, again, if you want to play pattern trader, there's your head and shoulders. Lower high underneath gives us a way to manage risk. There's your stop, there's your entry, and your target is a deeper pullback on the daily time frame chart. Once again, I'll say it one last time before we move along. The Qs will be more sensitive to rates that are moving in the upward direction. So because of that dynamic, the Qs are the better short based on this situation into the end of this week. Now, if we do not close this gap, if we just get high and tight consolidation, let's say that the 7-year, just to spite me in the commentary that I've been given here, the 7-year spites me tomorrow and it goes sideways, the bond goes fine, and we just get consolidation up here. Is there anything to really do on the bear side of the market? Not really. The patience play would just be looking for an exit of the previous day's range, right? Inside bar, very classic setup, higher low outside of range, and now we're back off in the races in the upward direction. And because of the prevailing winds on the daily time frame chart, because of the momentum, because of the trend, I would certainly be looking for upside again if there is no breakdown underneath this level right here, 421.25. Let's be congruent with our approach and take out the Fibonacci's from the low up to the high and just make sure that we're still on the same course of action. The 61.8 is still reinforcing the idea of that 412.75 acting as a new line in the sand. From the weekend update, we had talked about how this could potentially act as the level. Now that we've continued to make new all-time highs, pushed for a higher high out of this 2-day balance range here, I would concede that the top and the breakout point, the neckline, if you will, of the inverted head and shoulders on the daily is much more important now with the 61.8 providing confluence. It's the lower edge of the weekly expected move. There's a gap filled down here. So this zone in its entirety, very, very important if, again, big word if there, we get the breakdown underneath 421.25. So that is your downside reinforcing 412.75. Let's clear that up. Let's throw on our anchored view apps intraday and see what these are telling us. So same ideas for the most part. Gap fill reversal still keeps us bullish. Again, as long as we're outside of this 2-day balance range, you're still looking at this as a beautiful higher low. You're getting confluence. And if we slip underneath, neutral, more bearish underneath 421.25. So all of that is playing nicely. These are providing confluence down here. This one's a little bit in no man's land. If we anchor to this low, it's kind of in the midpoint here. So you could keep an eye out for that one, but it really holds less import. This, of course, was the larger breakout on Friday, and these were much more meaningful. That was the top of the balance range, and this was the sort of recapture, if you will, of the balance range. Specifically on the S&P is where those anchor dates come from. Let's move along. Let's take a look at the NASDAQ side of the internals. What you'll notice is the same exact thing. Bullish consolidation, bullish consolidation, bullish consolidation. Not the best bullish consolidation, but certainly more magnitude over the zero line as compared to underneath. Things really didn't get all that bad into the Tuesday afternoon as we were going sideways and consolidating before the breakout. You can see the same thing with the cumulative build down below in the ticks. On today's session, if we're evaluating the sort of pullback that took place, again, where were we from an advanced decline line perspective? Over 500 before the bond auction. We were positive before the bond auction. Actually, let me double check. Yeah, 1 o'clock. There you go, 1300. There's your 1 o'clock bond, right? Same thing out of the build in the cumulative tick, right? You were positive ahead of that, and then the mechanic of the market really drove things lower once that ultimately was in force as a driving factor to the downside. Let's quickly take a look at our market profile for our NQ. And we'll do this all in one take here, and that way we can keep this show on the road. Same commentary. Here are your value areas on Monday, Tuesday. Here is the value area today. It's not as slammed towards the highs of today's individual session. The point of control is slightly lower. If we go back on over to the ES, what you'll notice is the point of control is higher. The value area is a little bit higher in the session. So, it still strikes me that, the NASDAQ could be the one that pulls back just because, you don't really have people as excited near those highs to sort of execute even when we got a partial gap fill reversal on that morning session while making the afternoon high before the 1 o'clock bond pullback. I feel like this is getting very wordy today, so let me know in the comment section if this is too wordy with these bond auctions and the way that we're focusing on them, but it's really, really relevant stuff, right? That as a catalyst alone was a big deal for the price action that we saw today, and it's going to help us inform decisions as we move into the end of the week. Let's take a look now at the small caps. And last but certainly not least for the broad market today is IWM Russell 2000 and the small caps, and honestly, this is really where a lot of focus should be into the end of this week, because if there is going to be the healthy rotation where small caps are going to pick up the baton on a little bit of a tech pullback and the S&P is going to sustain the rally towards these all-time highs, then IWM wants to find, or needs to find, we should say, a higher low here to really cement the inverted head and shoulders on the daily time frame chart, and thus on the weekly time frame chart, as we talked about in the weekend update from Saturday. This would really start to make me more of a believer in the hammer higher low at the 38.2 at the weekly 200 SMA, right? If we come in from the low up to the most recent high, the hammer low of last week's bar went right to the 38.2. We know that this has been a constructive wall-to-wall move from the bottom all the way to the top of the balance range, a higher low knocking on the high in equal highs and short proximity of time should open the door in the upward direction, and this is really what would unlock the broadening nature of the market rally in its entirety. So really watching that out of the IWM, if we just bring it back down to a daily time frame chart, again, the idea is that the weekly higher low would have more confidence, or I would have more confidence in it if the buyers could prove that we're starting a new daily uptrend with a higher low, because keep in mind, we have the first component, right? Technically, we had highs, lower highs, and now we have a higher high. From here to here, we have a higher high, but we do not have a cemented higher low yet on the daily time frame chart. We have lows, lower lows, and lower lows. So if this can hold right around in here, 193.50 is the structural level from the bottom of this as a balance. The gap fill reversal is a little bit underneath at 192.85. If that can hold on the daily time frame chart for, again, your very classic inverted head and shoulders, I would be game on for a breakout here, being very, very constructive for the broad market as a whole. So into the end of this week, IWM around 193.50 is a really big top watch. It's a big priority for me to make sure that, okay, if we're going to remain constructive, bullish on the broad market, we need to hold here, and we need to look for this and then a breakout over time. If we start to slip that, then this is really nothing more than just a weekly lower high. What you'll notice is that we came in for a perfect gap fill reversal, certainly extended through the upper edge of this week's expected move. We certainly broke out and extended a little bit through that. It was on a gap up from the Tuesday session. Monday, of course, gapped up as well. We left that gap unfilled. And this morning, we opened at the previous high of day, basically. So for all intents and purposes, we do not have stronger sellers getting involved in this market here over the last 3 trading days. The buyers are sustaining price quite nicely, but it all hinges upon really cementing, again, as I've said over and over now, the higher low at 193.50. So that's the main takeaway here on the daily time frame chart. As we get more granular on the hourly time frame chart, what you'll start to notice is that there was not a whole lot of price acceptance outside of Monday's high, or the upper edge of this week's expected move. In both instances, when we opened near this prior closure of the gap, if you will, you can see the sellers sold it off aggressively, and then we consolidated underneath. Sold it off aggressively, there's a lower high at that level, and then we see that 1 p.m. bond auction weakness into the afternoon as well on the small cap. So far, again, it's not that the daily sellers are making big progress in the downward direction. As a matter of fact, I would say it's the opposite with the higher high happening here, but the hourly chart just simply cannot get in gear like the S&P or the QQQ when they were consolidating. I would only concede that Monday was a very strong show from small caps, which really drove a majority of the gains thus far this week. So far on today's session, this is just a bearish engulfer. So my hopes are somewhat, limited, and I'm managing my own expectations because of the bearish engulfer that was formed on today's session, but I'm still watching this level like a hawk to see whether or not buyers step up near this gap fill reversal, near 193.50, the bottom end of this previous range, or not. So that's the name of the game out of the Russell. So far, I would say that the trend is fairly neutral up here with low equal low after pulling back from these equal highs. So much more neutral. If you were looking for a man ray pattern, there it kind of is here. Any lower highs again underneath this 196.50 kind of set that up, and then a larger breakdown here. That's what the sellers want to see. If you're bearish on the broad market, if you're one of those people who are like, market's gone too far too fast, I'm contrarian all the time, this market's got to crash and burn, you want to see this man ray unfold right here in your your IWM, Russell 2000, and the small caps. Target after the gap close would be this equal high breakout point at 191.25, and then we'll take it in stride from there into the end of this week. In the upward direction, any sort of higher lows above that level we just discussed, 196.50 here, that would be a good first step. Notice that we have not produced a higher low or any sort of buy side reaction over that level. Opening somewhere weak for tomorrow's Thursday open, battling through it, higher low above, feeling much better about this holding as a right shoulder as we've described thus far. So small caps, in my eyes, kind of hold the key here for the next sort of sequence, if you will, in the market. If the QQQ is going to pull back aggressively because rates are moving higher because of bad bond auctions, because, you know, we're pulling back from all-time highs, because we can afford a higher low, but the IWM is also pulling back, it's just going to make for a much nastier pullback in the S&P itself. Whereas if the IWM is holding on here, your SPY can probably go sideways and sustain the uptrend a little bit more cleanly as compared to the opposite, which again would be downward here and downward in the QQQ as well. So that's your big driver out of small caps. Let's take a look at the small cap internals. Again, bullish move on Monday, totally validating that break. The gap and go was valid with strong volume inflows up and over 125 million in trend higher zone all day. The cumulative build left a little bit to be desired, and that's primarily because on Monday you did see a little bit of that pullback and then only rallying to close at an equal high into the end of the day. Didn't really have a chance to build that cumulative tick early on in the session. So, you know, the fact that the close was strong will give the buyers the benefit of the doubt, but it's not as good as it could have been when you sort of shadow that or compare it with what happened here and here. Still giving the buyers the benefit of the doubt. Strong move on the Monday session. For Tuesday's selling, again, notice that we got a gap and crap, if you will, complete sell-off. Really didn't see strong volume outflows. Cumulative build was mild. Same thing happening here on today's big bearish engulfer. Again, like in the 3-day sequence, I would not make the argument that we have stronger sellers. They're just not there on the volume flows. This, again, it looks nasty, but we're coming from a gap up and over trend higher zone. So, I mean, the buyers had their chance, and sure, we don't have strong buyers. Like, let's not get it twisted. This is not a bullish indication here, but do we have aggressive new money sellers hammering small caps? It currently looks like the answer is no. Otherwise, this would have been negative before the 1 p.m. bond auctions. You know, I probably sound like a broken record on all of that analysis thus far. So here is the market profile for the Russell side of the futures. I would just point out that value area and point of control did migrate lower with price on today's session. Russell tends to do that, makes one strong move. We talked about this in the pre-market prep the other day. Makes one strong move and then just kind of sits there, right? And that's certainly what you got on Tuesday. Big move lower, point of control migrated lower, same thing here. So overall, if there is going to be a breakdown, I think that all of this could easily turn into overhead supply because we're right on that cusp. Whereas if we just go back again, the comparison is really, I hope this is helpful to compare back and forth. The IWM on a relative basis is already trading here. Right, so you can see how there's more of a downside threat in the IWM compared to the ES and the S&P, which is up here, right? So keep that in mind when it comes time for selection and just understanding whether or not we're going to close this gap. Here's the Monday and Friday gap, Friday and Monday over here. So keep that in mind, right? That's the main illustration out of the market profile. Nobody wanted to commit volume up here at these highs on these gaps after the Monday sort of rally, if you will. It was one day of hurrah. Nobody wants it anymore. Nobody wants it anymore. We're sort of waiting for that next piece of information. Small caps, again, in my eyes, hold the key. If they can hold that sort of gap fill reversal in here to give you the idea, that would be around 1960 in your Russell futures. If we can hold that, good to go. If we start slipping underneath, I think things get much more difficult to navigate in the S&P 500. Let's get granular and take a look at the weekly performance of our S&P sectors. Leading the pack is none other than the XLE Energy, up 2.24%. And yes, energy is technically a lighter weight sector, but I'm not concerned seeing it at the top of the list for two reasons. Number one is that it's a lightweight sector, but it's not a risk off style sector. And then number two, along those same lines, giving a little bit of context here, it's followed up by heavier weight risk on style sectors. Now, don't get me wrong, the SMH is not technically an S&P sector, but chip makers, definitely more risk on than risk off. Same thing with communications, XLK, the heaviest weight risk on style sector for the S&P, the XLF, third heaviest weighted sector by market cap, also more risk on than risk off. It's not like it was energy and then utilities, consumer staples, real estate leading this breakout in the upward direction. So for the most part, posture continues to strike me as being more risk on as compared to risk off. At the bottom end of the barrel, speaking of risk off, it's real estate, which is extremely lightweight, utilities, more risk off, and the XLY. We're going to dive into that one because of what's happening with Tesla and earnings after the bell. The XLV is the wild card, and honestly, being the second heaviest weighted sector, it almost balances out with the third heaviest weighted sector, the XLF. Then your XLK pulls things back in the upward direction to once again signal more of a risk on style move for our market. Let's check in on the structural charts. Another reason why we're not concerned with the XLE at the top of the list is it's not outperforming on a structural basis. We're not breaking to new all-time highs. It's just rebounding back in the upward direction. As a matter of fact, there's still very much so a threat for a potential lower high underneath this as overhead supply up against 82.75. Getting some sort of rejection like that would actually be a little bit more concerning. Ideally, energy goes sideways because that would speak to more neutral appetite for sort of global demand of energy, and that might have better implications for sort of economic expansion. Remember that when energy is drilling towards the center of the earth, nobody needs oil, nobody needs energy. It doesn't really bode well for economic conditions. So no pun intended there with the drilling towards the center of the earth. Let's move along. Let's take a look at the SMH. Let's just go over it once, and then it'll be rinse and repeat commentary for many similar sectors. Of course, looks very similar to the QQQ. Inverted hammer on today's session, gap up, partial gap fill reversal. A couple of things can happen here. Most bullish is staying over the 2-day highs, consolidation here, then breaking in the future for some sort of daily bull flag breakout. We'll look for new all-time highs, and that would continue to remain a risk-on indication. Even if we pull back deeper, breaking down underneath the 2 equal lows can yield a deeper pullback, but do you see any concerns here? No is the answer. We are still looking for a daily higher low, weekly higher low at 176.65. So take that exact analysis, give it a rinse and repeat over here for the XLC. We're not technically at new all-time highs, but the same point really remains, where a hold over the 2-day highs looks bullish, or even a hold here over this breakout point still looks bullish as well. That is 74 as a line in the sand. Any pullbacks deeper than 74, we will reevaluate the chart. Same thing over here in the XLK, rinse and repeat with the same exact structure, basically. 2-day high holding bullish, anything deeper than this, looking for a larger pullback down here. Could that yield a deeper pullback for the S&P as a whole? The answer is absolutely, if there is no rotation out of some of the other sectors, which we'll get to right now. So the XLF, here we go. This is not quite a rinse and repeat because you can't really afford for a deeper pullback underneath the top of this prior range high at 38. Reason is that this certainly starts to suggest a look above and fail. And if we have look above and fail and the target's the bottom end of the range, and the XLK is pulling back, and this is the third heaviest weighted sector, and the XLV is technically D for defensive, but also the second heaviest weighted sector by market cap, all of a sudden you're in this predicament where, okay, you're probably going to get a nastier pullback in the S&P 500. So watch the XLF as one of the outliers here to give you more of that edge in determining whether or not the pullback will be harsh or if it will be mellow. The pullback will be more mellow if financials can stay over 38. Let's take a look at real estate. Obviously, with rates doing what they did today, moving in the downward direction sharply, but really not seeing a reason for 36.60 to be breached. And as long as we're consolidating sideways in this range, I really don't think that real estate's going to be a major player for the S&P, so we'll move along. Utilities, with rates moving higher, it's almost a rinse and repeat of what happened here into the October lows, where people are saying, why am I going to chase yield in utilities and take risk on the stock when I could potentially just grab government-backed, secure things yielding at a higher rate? So if that type of phenomenon is going to continue, you're probably going to see an unwinding of this entire move, and being a lighter weight risk-off style sector, this doesn't really strike me as being like the end of the world for the market. So if there is going to be a healthy rotation, you would try to catch some sort of weekly, even monthly, maybe at this point, high or low. If you could just, and granted, bearish engulfer, so odds of that happening tomorrow, a little bit lower. Some sort of like higher low, a little bit of a drift, and then something that does this as a monthly higher low, that would be good, right? We don't want utilities falling off the face of the earth, but they also don't need to be outperforming, carrying the market in the upward direction. This also, as a rotation, would help keep things kind of more stable in the S&P, right? Let's say that the XLK is pulling back more aggressively. SMH, not technically an S&P sector, but you get the idea, right? These things are pulling back more aggressively. If we're getting some outperformance from the utility sector and the financials, as we just discussed, staying over 38, it's really going to be a more mild pullback for the S&P. So watching that dynamic, does the rotation continue to stay more risk on in nature? Here's the XLY. This is incredibly important to watch as we move into tomorrow morning's session, because technically speaking, with Tesla earnings out of the bag, we're opening right on the bottom end of this as a range. So the threat here is that this is probably going to be more of a risk-off style rotation than the XLF holding over 38. If this breaks down underneath the 2 equal lows, I think you're going to get a lot of drag in the S&P. So even if the XLF is holding up over that 38, if the XLY is breaking down from this as a balance range, I think it's going to provide more drag than the XLF would provide sort of lift in the upward direction, if that makes sense. We're comparing and contrasting this and this on a relative basis, given two potential situations, right? The best thing that could have happened, which did not happen, by the way, so this is a small back pocket piece of information for the market bears, is that we did not see this double bottom play out over the neckline. We did not see a rotation out of the XLY to join in the upward direction for the S&P as this breakout was taking place. Now, it's not the end of the world, doesn't mean short the market, but it is a bearish data point instead of seeing that more healthy rotation where there's participation out of consumer discretionary. Let's move along. Here is the XLV for the healthcare sector. If this is going to turn into a double top, you got to break that neckline here, and we do technically have thin structure through the breakout on this session in early January. If I take it on down to the hourly chart, you'll notice that it's an hourly bar that's straight vertical, right? So taking out this level here, yes, can yield lower prices for your XLV. And again, if everything is pulling back, even the risk off sectors are pulling back while the risk on sectors are pulling back, you will get that harsh and nastier pullback in the S&P 500. So watching some of these inflection points, I would say the main ones to really focus on: XLK is a freebie, XLC is a freebie, SMH is a freebie, XLF top of mind, XLY top of mind. XLV, a little bit less so. We're still on an hourly chart. Let's go to a daily. Here's the XLI. This, again, doesn't really strike me as being a major contender. If you wanted to watch anything, it's this level right here. If we're over 112.40, great. It helps the rotation remain more bullish, more mild pullback, softer move in the S&P. Whereas if we break down underneath, more of the harsh move, right? But really, XLI is not going to be as important as your XLY or XLF. That's the main gist of going through the sectors actually today. So we'll just speed it up here. It's the XLY and it's the XLF. Financials and consumer discretionary. Those are your two big watches sector-wise into the end of the week. Here's the XLP. No major concerns. I mean, just consolidation up here. It's not helping the move in the upward direction, but it's also not hurting it to a major degree. If we just stay stuck sideways in this range as the heavier weight sectors pull back, again, maybe it dampens things a little bit, but not a huge deal there. XLB, lightest weight sector of them all. I mean, if you wanted to focus on home builders, you could look at the XHB and look for something maybe to continue to catalyze this underneath this area in here. So that would be materials moving on the premise that home builders are sort of getting hit there. That would be underneath 81.35. So that is what we have out of the sectors structurally themselves. Let's move on over here. Let's take a look at our ratio grid. If you're not familiar with the screen as it loads up, take a look at this tutorial in the top right-hand corner on how to set it up, and you'll be good to go. Here's a risk-on indication that does strike me as bullish and healthy. XLF trying to resolve that still upward sloping 50 SMA. That does strike me as being bullish and risk-on. This strikes me as being risk-on because it's a defensive sector pointing in the downward direction. This is where we have issues. And remember, we said the two big watches would be the XLF, can we get more lift here, and the XLY, can we put in a reversal and not break down underneath the bottom end of that range, even with Tesla earnings, which so far don't really appear to be that stellar. Are the risk off sectors signaling anything major? The answer is no, the answer is no, and the answer is no over here out of real estate, being seen as sort of a hard asset, if you will. Let's take a look at some specialized ratios. This, of course, is a risk on indication. This is going to mirror that as a risk on indication. XLK really heating up and continuing to outperform dramatically. Here's the apples to apples comparison of the XLP over the XLY, or excuse me, inverse XLY over the XLP. Ideally, this holds on to this level at 2.38 and gets some upward lift. You really want to see that equal high sooner rather than later. The more time we spend here, the more it starts to feel like, okay, is it actually going to turn into a lower high and then a breakdown back into balance? All of a sudden starts to raise some questions about the credibility of this being a mild pullback as we move forward. So if you're in team pullback, look for this to move in the upward direction. If you're in team market needs to go to hell in a handbasket, you really want to see a breakdown over here. And that could be possible given, what's going on with Tesla earnings after the close. Again, we'll get into that in just a second. Let's move along and let's take a look at the dollar. What's going on with our dollar? It's in the midpoint of the range here. That's really not helping or hurting the market all that bad in my estimation. I mean, if this was really going to be a big headwind for the market, you'd see this breaking out towards the top of the range. You'd see this as an inverted head and shoulders, which, don't get me wrong, the pattern is there, but we're just not accelerating up and over the midpoint currently, which is at 103.50. So watching that like a hawk. And if we take a look at some supporting evidence for currencies, right, let's go on over to the gold standard, if you will, which is no longer the gold standard, but this as sort of a double top, you're getting this lower high phenomenon into a flat bottom. So you could really start thinking of this as a sort of descending triangle. Breaking down underneath 2000 should really be the catalyst that yields the dollar in the upward direction, and therefore stronger headwinds for our market. So it is possible that the dollar could act as one of these catalysts that causes a deeper pullback, but it just hasn't triggered yet. The pattern does look bearish. And we could take a look at silver, because silver is also not doing anything all that impressive. I mean, it undercut the level a little bit, just by a hair, but there's still very much so a real opportunity for a continued lower high. You can see if I zoom in on today's session, certainly an upper wick there indicating, again, weakness out of metals should in theory put upward pressure on the dollar, which again, via chain reaction, continues to put downward pressure on equities over here. Let's move along and let's actually take a look at interest rates via the TNX and see what's happening on this particular chart. So we did get that lift on today's session when the bond auction went sour. We can actually take a look at something like the ZN. It was a 5-year auction today. This is the 10-year that we're looking at, but they move, I don't want to say in lockstep, but fairly close, right? And you can see at the 1 o'clock time frame, here it is, boom. This move lower is kind of what continued to increase or accelerate rates moving in the upward direction out of something like your TNX as a product here. You can see that's where we really got this break up and out of a 2-day high. You can see originally we were starting to back off of it into the afternoon. So main point being is that if we just go back to that zoomed out TNX, is that there's still the opportunity, and this is why I said over on real estate, I don't really see us moving underneath 3660. As long as we're underneath 4333, I think we're good to go, but I do think that there could be a continued move to get there in the first place. And one thing to at least consider on the 10-year is that the trend line in the downward direction has certainly broken, right? This as a trend line is broken. So with that no longer really in force keeping the short-term trend in the downward direction, you're really relying on higher time frame structures to yield that lower high and keep rates moving in the downward direction, or a stronger reversal on the higher time frames, if you will. So everything at this point, in my eyes, really comes down to what is the reaction at 43.33 in the 10-year. Tomorrow, again, with the 7, I think that we could easily have legs to get there. And again, as we pointed out, if we take out the bottom of the 2-day balance, we'll look for that deeper pullback. If the 7 goes fine, then guess what? Just consolidating over here really wouldn't yield much change for your S&P markets. I mean, other than that, we'll look for more natural activity in the market to develop and not so much just a pure, reaction or mechanic to drive price in the S&P. Let's continue along and take a look at the inverted ZT. This is going to be a long one tonight. I can already feel it. The video is getting long, isn't it? Inverted ZT is moving slightly higher, so we would assume that we're still looking at another firm pause in the March timeframe meeting, because remember, we skip in February. So 2 pauses still the idea. Let's take a look. The answer is absolutely, but most surprisingly here, unlike what we saw on Saturday, where the amount of rate cuts was reduced down to 5, we're right back to 6. And keep in mind, the difference here in terms of probabilities is only 30 basis points. However, pricing in 6 cuts instead of 5 is more so a justification of the multiple expansion rally that we've seen, and the all-time highs that we set on today's gap up are more so justified as well. I'm not here to argue whether or not this will ultimately stick. Forecasting the Fed out that far is almost an impossible task. However, as of right now, it does strike me as being more bullish than bearish for our S&P markets, even though the odds of a pause have increased for the March timeframe meeting. If we just go on over to the compare tab and take a look at March, you can see lower odds for a sort of cut and higher odds for a pause over here. Let's take a look at the Forex calendar, and this is mainly what we're looking for is the manufacturing PMIs came back in over 50. Remember, over and under 50 is going to represent your expansion or contraction. For a while, this was contracting. So if we were concerned about economic output manufacturing-wise, like goods-wise, right? This is a decent look here out of manufacturing. The services PMIs continue to come in hot, and that, of course, as we know, is the sticky side of inflation. But if you want to avoid a recession, you really don't want your flash manufacturing PMI to stay underneath 50 for too long. You want to be continuously expanding at a healthy pace. So this, of course, if we're thinking about the narrative around recession, does strike me as a healthy data point. Now, sometimes, as we know, when we get into these situations, twisted sort of outcomes are what we're looking for. Good news can be bad news, and bad news can be good news. In this case, seeing this, I don't really think is going to have much impact on the Fed's expectation for inflation. And instead, I think when we're dealing with inflation data, good news is good news. When it comes to unemployment data, I think good news is bad news, because the market is going to take that as saying, hey, the Fed is going to stick to their guns with higher for longer. They are not going to cut rates aggressively. And all of a sudden, if that 6th rate cut falls off the docket, if that 5th rate cut falls off the docket, it becomes much more difficult to justify the PE or multiple expansion rally that we've seen thus far. The market may have to contract a little bit to adjust for what we already know is the case for a really weak looking Q4 of 2023 earnings cycle, which we're amid right now. Here's the bond auction calendar, just to give you the heads up. This is what we're looking at tomorrow. It's the 7-year note. Again, that is at Thursday, 1 o'clock Eastern time, January 25th, 2024. There it is. If you're ever curious curious as to where you can find this, it is the treasury.gov site. They post their calendar. So today was the 5-year. Tomorrow is the 7-year, 1 o'clock. Expect some volatility. That will continue to be something that we watch in terms of how it impacts interest rates. Let's move along. Here's the earnings calendar. Again, the big deal after the close today was, of course, Tesla. Let's move on over to those charts eventually, and we'll take a look at what's happening there into the end of the week. Visa will be your next largest mover because of what it represents in the XLF now, the financial sector, instead of the XLK where it used to be with MasterCard for payment processing. So anyways, that is the earnings calendar. Let's take a look at some more supporting evidence. And what about the market's appetite for risk? The TLT ratio to the S&P is clearly drifting in the downward direction as we're gapping up to those all-time highs. So for the most part, this would speak to a stronger risk appetite for equities down below. And even if we provide more context, you can clearly see that this might be a little bit nerve-wracking at first. Here are bonds in relationship to themselves, short-dated versus slightly longer-dated, and these small uptrends here, here, and here would suggest that people are favoring the shorter end of the curve. So why are they favoring the shorter end of the curve? Is it because of a mass panic, or is it just because people want to lock in higher rates before the Fed ultimately starts cutting rates as soon as possibly May of 2024 based on the tracker tool? To me, it's the latter in those two situations, and there's clear evidence of a lack of panic. People are not panicking if you take a look at credit spreads. They continue to drift in the downward direction. Don't get me wrong, this is slightly more sideways compared to the downtrend we had here and over here, but there's still a strong opportunity for a lower high underneath the downward sloping 50 SMA, and the same thing down here in our shorter dated credit spread, SHY-HYG. So for the most part, this does not scream credit event incoming or duck and cover. Bad things are about to happen in the market. Now, don't get me wrong, these things can change rapidly, but as in if they break those 50 SMAs, we'll be able to update you over the span of 3 days in the case of a Saturday update towards our Wednesday update, or a 2-day span from our Wednesday video to the Saturday video. So you'll know well in advance if a credit event is around the corner. There's just nothing about the bond market currently, other than the bad auction that went on today and possibly a bad auction tomorrow, that is suggestive of like, oh my God, people are sniffing out a deep, dark, dirty recession or a credit event. It's just not there when you're looking at the evidence and providing more context via what we've looked at today. Here's the HYG. It is suggesting that a pullback could be likely, right? The HYG has a slightly lower high and a more meaningful lower high, whereas the S&P equities in isolation have an equal high and a higher high. So could we break down underneath the two equal lows to correct the relationship between the two? It is possible, and this is one of the larger arguments for the bears at this point in time, saying that no, this market rally cannot be sustained. The HYG high yield is not playing nicely. There is a bearish divergence. This is one of the ones that we were discussing in the intro. The market internal is not playing nicely with the breakout this morning, and the gap up was divergence number 2 that I at least had on the top of my mind. Let's move along. Let's take a look at Bitcoin. This is, again, just like it's never one-to-one in terms of risk appetite remaining strong in the upward direction, it's the same thing to the downside, right? We can't be overly bullish when Bitcoin is breaking out for the market down below, just like we can't be overly bearish when it's breaking down for the market down below. But overall, the lower high is possible here underneath 40,662, and that would just be a slightly more bearish pressure for financial markets as a whole, a slightly less or lower indication of risk appetite, considering that Bitcoin, in my eyes at least, is still one of probably the most speculative asset out there. Let's continue along and take a look at some market breadth. It is moving in the upward direction, small uptick higher away from the zero line positive. That is bullish, and keep in mind that you don't need blockbuster reads as rallies begin, as you're making new all-time highs. Remember that after the sickness, these were all-time highs as we went on that march in 2021. Not March as in the month, but the march as in the slow one step after another in the upward direction. And the same thing looks like it could be taking place here. We have a recovery effort. We're over zero. We're not getting negative prints. Same thing is happening over here. It's not the best looking read, but it's also, we don't need the best looking read on the recovery arc, if you will. Let's move along and take a look at some other breadth indications. Here's the SPX A200R on a weekly time frame chart, ticking in the downward direction, even though we're gapping up and moving higher here. This speaks to breadth sort of contracting a little bit and getting concentrated returns out of things like your NVIDIA and your Meta from this week. And you'll see the same thing here on the SPX A50R. You'll notice that we're at an equal low, even though we've gapped up to a new higher high and pulled back to a higher high as well compared to last week's close, right? You can see that here versus here. Obviously, this is moving in the downward direction. So I'm still of the belief that this would suggest if the heavy hitters, if the Magnificent Seven pull back, and you see a healthy rotation, meaning that the sectors play nicely, this has more of an opportunity to act as like a double bottom, or it plays catch up back into nice, confluence zone up here over 80%. in my eyes, that's a stronger possibility as opposed to saying, okay, this is going to drill towards 50% and it's going to be the end of the world for the market over here. I don't really foresee that as a stronger possibility, but we'll keep an open mind. As of right now, I think that this offers much more of a rotation supporting piece of evidence as compared to bearish piece of supporting evidence. Let's move along. Let's take a look at the RSP in isolation. And again, this is your equal weight up above. And I think this agrees with everything that we just outlined on the SPX A50R, right? We're teetering right on the edge here. I think there's an opportunity for this to hold as there's more of a healthy rotation in other sectors as maybe the XLK cools off a little bit, as your NVIDIA cools off a little bit. This goes sideways, this pulls back, and now all of a sudden, a retest to the top of the range, and this is still sort of at the top of the range, they start moving in lockstep, right? If this is at the top and it starts to push away, this breaks out of the range, now all of a sudden we're good to go from a breadth perspective. So watching that closely out of the RSP, the QQQE, of course, is playing much more nicely with the weighted NASDAQ down below. No gap close on today's session, gap close on today's session, but for all intents and purposes, higher high, outside of the previous high, outside of the previous high. So all good over on our NASDAQ from a breadth point of view. We know that the NASDAQ has been playing nicely by itself. Here's the Dow Jones Industrials versus Transports. They're still saying not yet. Still saying not yet in a big way. Again, it doesn't mean go out there and short the market, but could you be looking for a pullback based on this? I don't think it's unreasonable. I really don't think it's unreasonable if you're more of a Dow theorist sort of follower. But again, wouldn't mean short the market. It maybe means look for a pullback, or at least don't be. This is my takeaway, right? If you just want my bottom line on this divergence, it just means don't buy the all-time high when you gap up to it. It means don't chase the all-time high on a bull flag breakout intraday on the S&P, right? If you get a bull flag and you're the new money long right here, and these are divergent like the way they are, I mean, you're just kind of asking to get, in my eyes, a turnaround and then get trapped at the worst possible trade location. So that's my bottom line on market breadth. I think that it's teeter-tottering right at a key point. I think that breadth can improve if we see the proper sector rotation, but probably not risking it all at new all-time highs with a, basically no place to manage your risk against. Here's the VIX. VIX is still suppressed down below. Nothing really to talk about there. But in the VVIX, volatility of volatility, if we could pull up the right tab, there we are. Notice it's like clockwork. It is like clockwork. Gap down into 75 this morning. Moved to 75 over here, ticks higher. This is our precursor. So if this continues to move higher, then great. We'll look for a sustained pullback. But if this just wants to neutralize and kind of pull off one of these like it did a couple weeks ago, then no big deal for our S&P 500. I really don't think you're getting an Armageddon type sell where maybe you move back down inside of the balance area that we've been talking about in detail over the last couple of videos, right? If as long as the VVIX remains suppressed, as long as it's underneath 103, you're probably not moving into this lower balance, at least in a volatile manner where you have to duck and cover, and oh my goodness, the market's coming crashing down, right? Here's the VIX futures moving into contango still. The 9 versus 30 day is at the zero line, but still technically in a contango, so good to go on a volatility front. Let's move along and take a look at the core list. Apple is up first on the chopping block daily time frame chart. Looks like it's about ready for a pullback. The reason for that is we do have a red inverted hammer, and more importantly, you could even dissect this on the hourly. We'll go there in a second, but we broke out over the two equal highs in the upper wick, then we closed weak back down underneath those two equal highs. So very straightforward trade on the daily always is short underneath the inverted hammer low, looking for the pullback to sort of continue with a stop over the high. Now, of course, if this is your risk, you need to make sure your reward compensates you properly. But the idea remains that that's sort of what we're looking for directionally. On the hourly time frame chart, you can see it as clear as day. We got this little opening pop higher after holding pullback into the previous day's range. Then you can see we tried to hold it. The 1 o'clock bond news, of course, kicks things off in the downward direction. So any continued lower highs underneath 195.25 set up the continuation in the downward direction in my eyes. So instead of using the risk reward from the daily chart, on the hourly here, you're looking for a bearish setup underneath 195.25, and your pullback would firstly be down towards 191.75. Let's go back to the daily chart. Then 188.50 is a larger line in the sand because of what it represents down here from a double bottom point of view. If we do move in the upward direction, you need to find price acceptance over that 195.25, and on the hourly chart, looks like it'll be more difficult considering that this is going to act as overhead supply. So to me, it's more likely that you'll reject here. You'll continue to find lower highs underneath that 195.25. If that changes, great. Higher low happens here, and then an equal high breakout up and over roughly 196 flat. that. Let's move along and let's take a look at Microsoft trading at new all-time highs. Nasty inverted hammer on the daily bar. Excuse me, earnings are a little bit further down the line on this one. You have a 3-day balance to be contending with prior. So let's take a look on the hourly chart here and see what else we can learn. On the hourly chart, I mean, there's no clean structure here that I would say, aha, here's the pattern that we're trading for. If we do slip underneath this gap and into the 3-day range, now all of a sudden, I would be more concerned about something that looks like this. There's your head and shoulders, left shoulder, head, right shoulder over here that we already have on that lower high. Then a breakdown through this neckline sort of kicks things off more firmly in the downward direction. If we're just consolidating up here, it's very difficult to say anything bearish about Microsoft. I mean, new all-time highs, bullish consolidation, holding this very minor gap up, break up and over 405.50, continues to put this one up in blue sky territories. Here's Google, very close to new all-time highs, not quite there yet. You can see it on the daily chart here at 150-155. Same concepts with the inverted hammer here and a gap underneath us. Technically speaking, gap fill reversal keeps a higher low in the hourly trend count with lows, higher lows, higher lows, higher lows. So 147.15 would be a top watch. Any consolidation up here, 2-day high breakout, boom, off to the races, and that all-time high would be the target. Once again, 150-150. Stronger sellers only have an edge if there is no gap fill reversal. If we slip through it, lower high underneath, and again, a lot of these similarities will continue to reveal themselves. There's your head and shoulders on something like the Google hourly. Here's Amazon. We're still on the hourly chart here, folks. This one is a little bit more enticing to me for pullback longs over anything over 155.25. The daily bar is certainly nasty. It's an inverted hammer like everything else. Actually, it's a solid red-bodied bar. A little bit of an upper wick, not as much of an inverted hammer, but you get the idea. Any pullbacks here that hold this at 155.25, look at the daily chart. Look at the daily chart here. Look at the level here. Beautiful higher low, looking to trade back into the equal high, and then if not, towards that 163.50. There is more room to run out of Amazon in the upward direction, and not for nothing, you could do twofold here. If this is the balance range, a double, we're not quite there yet, so that still has some legs behind it, and more importantly, if this is going to act as your inverted head and shoulders, pie in the sky, just like the QQQ did on the daily time frame chart, again, that 163.50 suddenly doesn't seem so far away. So keeping that in mind out of Amazon. Next, let's take a look at NVIDIA. Look at this, Bank of America. I remember calling them crazy. This was for 2023, so let's not get crazy in the video here today. But Bank of America called 650 end of year 2023. I don't know about that. So we are rapidly approaching, and maybe we get there for 2024. But as of right now, let's remove that level. That's funny. I actually didn't even remember that was up there. Anyhow, on today's session, beautiful rally out of the gates. And again, this is really one of the concentrated breadth components that drove your S&P higher today, drove your QQQ higher today. The pullback into the afternoon was not nearly as bad. So on the NVIDIA chart here, I would really be looking for any higher lows, excuse me, around the low of today's session, the open of today's session, a retest around $600.50. Anything around that zone, I really, excuse me, the voice is starting to kick out here, so bear with me, folks. I really don't see any reason to be bearish on NVIDIA. You could also start coming in with your trend channels and say something like this. NVIDIA, it tested the top end of the trend channel. It's probably even a little bit more aggressively through the top of the trend channel here. Any sort of pullback is reasonable towards this zone down here. Again, $600.50. It's the name of the game. Anything that's making new all-time highs usually is in an uptrend. We talked about this on the SPY Daily. The name of the game is searching for higher low pullbacks or equal high breakouts, right? That is excuse me, is really what you're looking for on these charts. Meta is up next. New all-time high was produced. So again, keep it simple here. You had range compression over 2 days. Inside bar on the Tuesday session. Breakout today. Great one to catch early on in the session. The pullback has not been detrimental. I would add this level to your chart here at 388. 388. We didn't want to auto zoom. We wanted to go round numbers only up here in the penthouse. There we go. 388. Any pullbacks that hold that are looking pretty darn good for a daily higher low, hourly higher low, even if you're counting trend lows, higher lows, higher lows. Technically higher lows here coming from the highest high in the trend sequence. So good to go from that point of view. 388 is your number. Blue sky territories up and overhead. On the daily chart, I just want to make sure that we're not missing any clear patterns here on the daily in terms of like measured move forecasting. Not really. Nasty inverted hammer. So again, maybe you get a pullback first, but as long as you're over 388, that's your line in the sand. Even prior all-time high, daily higher low, absolutely. Absolutely, right? Here we go. Tesla. This one. Let's take a look at the after hours. Let's turn that on so I'm not misleading you here. I drew in the measured move. I drew in the measured move. This is the market maker expected move. It was plus or minus 1479, give or take, from the close of the session here. So plus 1470 something, minus 1470 something. We're basically at the one standard deviation move there from the market maker's expectation. So looks like we'll be suffering from a gap down out of Tesla. And again, we sort of knew this from the XLY analysis that we performed earlier. Let's go back onto a daily time frame chart. We're opening at this equal low. So I would honestly think, excuse me, that Tesla could be an exhaustion gap down tomorrow. We know that it's really been severely beat up through this here, gapping down into a known area of support. It is coming from a bit of a balance range here. So is it possible that some shorts are going to look to get paid out on that particular move? I think the answer is yes. Anybody? Wow. My apologies. Might have to cut it early here. Anyone who is consolidating or building shorts in this position might look to cover those shorts on the gap down. That is their payday. And ultimately, for that reason, you could see some upward lift, some inventory correction to Tesla early on in tomorrow's session. We'll cover it in the pre-market prep to determine whether or not gap rules are enforced. But so far, so good. Looks like we are gapping into support. And for that reason, again, everything that we just described, I'd probably look for a gap fade out of Tesla tomorrow morning. Next up, Netflix. Speaking of gaps, major one. Major gap out of Netflix in the upward direction, nasty inverted hammer. This really requires letting structure build out. There's nothing really constructive I can tell you about Netflix up here other than you need to manage your risk somehow, some way. So on the hourly time frame chart, a couple things that you might at least want to be prepared for is if we break down underneath the opening print, I mean, obviously there's structure underneath the close. If we move back in the upward direction, you probably don't want to be an aggressive long until we can clear this high set here at 558.25. And in that case, your next big target overhead is quite a ways overhead at 585.65. Let's go back to the daily chart. I just want to illustrate where that's coming from. We really got to open this chart up. Netflix, it's been a little while, but look at the thin structure. Look at the thin structure off to our, in this case, it would be left. This in here is what we're looking to retrace. So that's up and over the high of day from today's session that we saw. And again, it's off to the right. There's your 588, right? It's this prior pivot low where the selling really accelerated down underneath. Now that we can auto zoom this, we can take a look over here. I'll just give you that look one more time. There's your 585. And, this obviously is what you need to break out over 558.25. All right, enough about Netflix. Let's move along to the 4 trade ideas. We'll speed this up so my voice can hopefully be intact for tomorrow's pre-market prep. We'll be live in the saddle. Here we go. Roku. What's going on with Roku? Roku looks like a short to me. Reason being is that it's one of the weaker tech names, right? Roku has never performed well over a long span of time. It is pulling back. It's in a downtrend here. Bearish engulfer rejected the 50 SMA, rejected this equal high here. So if we can break down and continue underneath 87.50, my target would be the low down here at 82.50. Here it is on the hourly time frame chart. And you can see that there is, basically what we're looking for is the breakdown of this zone. You can see prior resistance, 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 acted as a little bit of support happening here. If we slip it lower high, that is your target. So that is Roku as a potential short, looking for underneath 87.50. Let's move along and we'll look at Snow. Snow is a continuation play, and Snow was on our radar thanks to the pre-market prep. Big shout out. I'm going to have to look back and see who it was. Feel bad for not remembering, but I'll put that on the screen now. Anyways, the pullback here to retest the top of the breakout point at 201.25 is what we're looking for. Great gap up. If you had it already, we were talking about it on Tuesday morning. Hopefully you took some profit on the gap up, especially as a shorter term trader. But if you missed it, basically what we're looking for is a retest of 201.25, higher low, and then we pick it up in the upward direction. If we zoom out to a weekly time frame chart, there's a really meaningful breakout as long as we can hold that 201.25, extending off to the left, clearing this zone. You can see that there's some room to run. So for swing traders, even someone who wants something on longer, this is a huge ascending triangle, right? If you just do something like this, you get your ascending triangle. We're clearing that flat top and the target over time, 235.75. So that's your snowflake trade, looking for a pullback re-entry on this one around 201.25. Next up, we have ADM, which could go either way. Let's drop it back to a daily time frame chart here. Could go either way. Got hammered over here. 2 inverted hammers back to back inside bars. Technically, this is a 3-bar play now, 4-bar play in the downward direction. Sweeping the lows would make the most sense considering the trend here. However, if we're going to get a squeeze and a rotation into like more consumer staple style sectors into the end of this week. If tech is going to pull back and then consumer staples are going to sort of outperform a little bit, if that baton is going to do the dance and be passed back and forth, I think that there could be a very obvious squeeze up and over 54. Now, I'm not convinced that the options market is what you want to use here in ADM. It is easy to borrow, so if you want to short it for a bear flag breakdown, shares are available, at least on Thinkorswim. I'd have to imagine on any big broker they're available. But over 54 could also be a long up to this opening print, and then of course it's the massive gap overhead that you want to contend with. So 58 and then 68, about 10 points in there for the gap to close overhead. That's ADM as a backup idea. And then lastly, we have Walmart, WMT. Seems like good timing here as the voice is really kicking up. That's unfortunate on my part. But anyways, pullback on Walmart to 159, higher lows around this area. You know the name of the game. There's your inverted head and shoulders. There's the neckline, a retest at that zone after a higher high. Good to go. The trend remains in the upward direction, seeing if we can spot buyers at 159. So it's got some more work to do. Today did produce a bearish engulfing bar. Technically, there is not much saving us if we break down underneath this equal low. It's thin structure back here for that full test of 159. So watching that continued pullback, then can we find buyers down here? You know the name of the game. It's the double bottom. It is the inverted head and shoulders. It is the very simple hammer candle down here at 159. The retest, or the target for a day trade, should be a back up toward, 160.50. Wow, good thing this is the last idea. 160.50 would be the first retest for something over those highs to retest here. Then we'll look for continuation back up into this range. That is going to do it for today's episode of the Midweek Market Update. I'm going to shut it down sooner rather than later. I do hope to see you in the pre-market prep. We hit a milestone today, 1,000 by 900 for the first time. January 24th, 2024 is going to go down in history as a trade Brigade holiday. We will be live for the PCE announcement as well on Friday. Free coffee and donuts up in the penthouse. I hope to see you there. With that said, everybody, we'll see you tomorrow morning, and I wish you a green trading week.